Alrighty, so today's video we're going to be talking about the almighty put ratio spread strategy, and this is one of my favorite option strategy to use whenever I want to get into a long stock position. And that's because by using the put ratio spread strategy, if the market goes up, I make money. If the market comes down, I make even more money and I get into a long stock position as well. So this is something that you can't do if you were to just use the traditional way of placing a buy limit order, right? So in this video, I'm going to share with you everything you need to know about the put ratio spread and also why you want to use it, how to construct it. I'm also going to share with you a trade that I just placed on. I'm going to share with you my game plan so you know exactly what you can do for yourself as well based on the different scenarios that happens after you place the put ratio spread. Alright, so first off, what is a put ratio spread, right? So the put ratio spread is a combination of the long put spread and the short put option, right? So the long put spread is also what you would commonly be known as the bear put spread, right? Basically, it is a bearish strategy, right? So for example, if the market is this way, so the long put spread is basically what you do is you buy a put option. You buy one put option somewhere at the money, or you can buy one slightly in the money or further out of the money. But generally, the place where I like to do it is to buy somewhere around at the money and then sell a further out of the money put option. So this way you have a put spread down here. You are long a put option and you're short a further out of the money put option. So this way, if the market was to go down, you'll be able to make the profit on the difference between the strike price at expiration, right? So this is the essentially the put spread. So the short put basically is used to finance the cost of the long put spread, because the long put spread is a debit spread, right? You have to pay for it. But when you have a short put, right, let's say you sell a further out of the money short put, so this credit down here is used to finance the debit that you pay for your long put spread. So in the end, this can become a credit, right? A total is a credit. So what we ideally want is to have the short put credit to be more than the bear put spread debit. Now, the reason why this is called a ratio spread is simply because there is a ratio between the long put option and the short put option. So there's always more short put options than there is the long put option. Now, some people like to do a different ratio. Like for example, in this case, this is what you call a 1:2 put ratio spread, where you are long one put option, you're short two put option, right? Some people like to maybe go for 1:3. So in this case, there'll be 3 short put options and then you have 1 long put option. Now you can go to 1:4, 1:5. It's very versatile. But the thing you need to take note of is that the more put option, the more short put option that you have on, the more risk you're going to take. But this also, of course, helps in increasing your profitability. But the trade-off is that it takes on more risk as well. And of course, you can also sell the put option at the same strike, right? Normally what a lot of people do is, right, let me just remove this. What people would do is that they will sell 2 put option at the same strike and then 1 long put option near somewhere at the money. So in this case, you have a put ratio spread where the short put are at the same strike. So you can see there's an embedded long put spread down here, and then you have a short put option as well, right? So I'm going to get into a little bit more about the construction of the put ratio spread, the different ways that you can construct it. It's very flexible, but for now you just want to know that this is why it's called a put ratio spread, because of the ratio. All right, so the whole idea of the put ratio spread is you want to route this whole order for a credit, right? A put ratio spread in general is a credit spread because you have the additional short put, right? The additional short put is meant to finance whatever cost that you're paying for the long put spread. So in this case, you can see in this example, the long put spread is $2.18, right? So you have to pay this to buy this long put spread. But then we're going to be selling the put option and we're going to receive $2.44. So in this case, you're going to have a overall credit of 26 cents, right? So that means you're receiving $26 per option contract per put ratio spread, right? Based on a 1:2, you're going to have $26 into your account, right? So for this put ratio spread, you can see that it's all routed for a single order ticket, right? You do not enter it as a separate order, you enter it all as one order ticket, and this is essentially the put ratio spread. So why do you want to use the put ratio spread? Well, first of all, the put ratio spread is a multi-directional strategy that profits in all directions, right? So because you're collecting a credit at the start when you're selling this put ratio spread, if the market is to go up, right? Let's say, for example, let me just use this example down here. Let's say, for example, the market is down here and you have your put ratio spread somewhere here, right? So you have two short put here and you have one long put option down here. Okay, so at this point of time, right, when you sell this put ratio spread, you're going to receive a credit, right? You're going to be receiving a credit. So if the market is to go up, right, it doesn't get into your put ratio spread at all. The whole spread expires worthless at expiration, and then you just keep the credit that you receive at the start, right? But if the market was to go down, right, then you will be profiting on this long put spread that's embedded in this put ratio. You will make the difference between these two strike, and then at the same time you will be exercised on your short option. So this way you'll be long 100 stocks, so 100 shares, I mean. So that is why I say this is a very good way for you to get into a long stock position, because you get paid on this long put spread down here. So this is a great way to get into long stock position, and you get paid to get into a long stock position, right? You get paid, the portion is because of this debit spread, right? So in order for you to actually get assigned on your short put, you need to first make money on the long put spread, right? That means you're sort of like incentivizing yourself. The market has to go down past here, help you make money on your long put spread before you can get assigned on your short put. All right, so psychologically this is a very good way to enter into a trade, because if you were to just sell a normal cash secured put or a short put to get into the long stock position, right? So let's say, for example, you do not have the put ratio spread. Let's say you just have one short put down here, right? So when you sell it at this point of time without this embedded long put spread, as the market goes down, you're going to be losing money on this short put, which also means that you could have actually sold this short put for much more had you waited until the market went down further. So psychologically, it's not going to be as easy to take in, because you're going to be seeing a loss on your short put as the market goes down. But with the put ratio spread, as the market goes down, you know you're going to be making more money because of the embedded long put spread, right? So that is why you get paid, right? You get paid much more than a simple short put, a cash secured put, when you are entering into this strategy. All right, so the other thing is that it is very flexible, right? You can adjust your strike to be more bullish or more bearish. Okay, so I'm going to be sharing with you a little bit more how you construct it, but basically when you're having a put ratio spread, you can construct it so that you collect more credit on the front end, so that if the market goes up, you receive much more money, right? The whole spread expires worthless, as you just basically collect the credit that you receive when you sell the put ratio spread. Or you can make it more bearish, in the sense whereby you increase the size of your embedded long put spread, so that the credit that you receive upfront for selling the put ratio spread is very minimal. So this way you're more incentivized for the market to go down, right? You want the market to go down to make more, because you have a embedded long put spread that is wider, that will make more money if the market goes down. So again, I'm going to share with you this in the next slide. So this can be seen as a mini hedge against a bullish portfolio, especially right now. If you do have some long stocks going on, then you want to have a more bearish put ratio spread. So this way you get incentivized, in a sense whereby if the market goes down while the rest of your long stock position is, you know, in a drawdown, you'll be actually making more money on your put ratio spread, because the market needs to go down in order for the embedded long put spread to make money. So that is why you make more money when the market goes down. Alright, so I'm going to share with you how you can construct your put ratio spread. So first of all, for the put ratio spread, we're going to be looking at a days to expiration somewhere of 30 to 60 days, right? The longer your days to expiration, the bigger, or rather the wider the width of the long put spread you can construct, right? So that is because your short put would be worth more. You get more premium on the longer days to expiration. Because of that, you can buy a more expensive, or rather a wider long put spread. All right. So for the short put, you want the strike to be at 0.5 to 0.2 deltas and or at or below a support level, right? Ideally, whenever you enter into a put ratio spread, you want to have in mind where is it that you want to long the 100 shares, right? Remember, we always enter a put ratio spread as a way to get into a long stock position. So in this case, let's say if you take a look at this table here, let's say you have decided that 105 is going to be the place that you want to long to get long 100 shares, is because there is a support level around here. Then you don't, you can ignore this delta position, right? Because you already decided you want to get long at 105. So in this case, you don't really need to care about the delta, right? But let's say, for example, the support level is somewhere much further down, let's say around the $90 mark, right? In this case, then you can use the 15 to 20 deltas as a benchmark of where you should be selling your cash secured put. Now, of course, you can wait for the market to go lower so that you can sell the cash secured put, or rather the short put, at the 90 strike price. Right, that's one option. Or in this case, if you want to just go ahead and sell the put ratio spread right now, and you actually don't mind, let me just remove this down here. Let's say you do not mind at all getting long at this 100 strike price, then this is the one you want to use, because it's roughly 15 to 20 deltas. Then after that, you can construct the long put spread. All right, so I'm going to share with you my own trade example where I use a support level to get into the short put side of the put ratio spread. All right, but that's for the next slide. So for now, let's talk about how you're going to construct the long put spread. So the long put spread really depends on your view, right? So there are many ways to construct this. That's why it's very flexible. So let's say you are more bullish, right? If you are more bullish on the put ratio, or rather on the underlying stock, then you can have a smaller width for your long put spread, which results in a smaller debit. So let's work this out together. All right, so let's say, for example, we've decided that our short put is going to be the 100 strike price, right? So for the 100 strike price, let's take a look at the mark. So the mark is around 1.645. So let's round it off. We're going to receive a credit of 1.645. All right, so for the 100 strike price, let's say we're going to be receiving a credit of $1.65. Okay, so when we are constructing this long put spread, we want to have a debit of anything that's lesser than $1.65. So let's see what we can construct down here. So let's go for a smaller width. So a smaller width would simply be, let's say we want to sell another 100 strike. All right, the put spread of 102.5 to 100. So in this case, we'll be buying the 102.5 strike price and selling another 100, right, strike price. So in this case, what is the debit for this spread? So let's do a quick calculation here. Let's just bring out our trusty calculator. So what we're going to do is we are going to buy at $2.08. So it'll be minus 2.08. And then we are going to receive a credit of 1.65. 1.65. So what this means, this is a total debit of 0.43. So down here, we are going to be creating the 102.5 long put spread, all right, with the 100. And this is going to cost us roughly negative 0.43. So if we take 1.65 minus 1.43, what is the net credit that we receive? The net credit we're going to receive is going to be $1.22, right? So as you can see down here, we have constructed a pretty small long put spread. The embedded put spread inside here is only 2.5 points wide. So that means if the market was to go below this 100 point, then we're going to make the full profit of $2.50, which is $250 on the put spread. All right. Plus, we're going to have this credit on the put ratio spread, which is $1.22. So we have created $1.22. That means if the market was to go above 102.5, that means the market, or rather the underlying stock, expires above 102.5 at expiration, then we're going to receive this full credit of $1.22, which is not too bad, right? Because if we were to just sell the cash secured put or the short put by itself, we're going to be receiving $1.65. And by buying this embedded long put spread, we're going to be paying 43 cents. So that means the overall credit is going to be $1.22, which is not too far off from just selling the short put. Now, the reason why you want to buy this, right, just the 102.5 100 for this put ratio spread is that in the event if the market was to go below 100 points, right, below $100 at expiration, what this means is that our profit will now be an additional $2.50 because of the difference between these two strike price, right? The difference between these two strike price will be our profit if the market closes below the 100 strike price. So this gives us a total of $3.72 if the market was to close below $100 at expiration. So that means if you're more bullish, you want to collect more credit upfront. Now, what if you are more bearish? If you're more bearish, then you want to create a larger width with a bigger debit on your long put spread. Let me just remove all this. Alright, so same thing down here. We have the 100 strike price for our short put. So we're going to receive $1.65. Now, let's see how big of a put spread that we can create, right? That costs slightly lesser than $1.65 or roughly equal, because at the end of the day we want to route this for small credit or even break even. We definitely do not want to pay a debit for this. All right, so let's take a look at which is the strikes that we can create for this. So let's say we take the 100 strike price, right, as the short end of the short leg of our put spread, and then we can see what else we can buy against it, right? What spread we can buy against it. So let's take our calculator down here and let us calculate to see which one we can get $1.65 or lesser, right? So let's take the 107.5. 107.5, we're going to be paying roughly negative 3.28, and then we're going to add 1.65 down here. So it gives us 1.63, which is just perfect, right? So the 107.5, and we have the 100 strike, and that gives us a negative of $1.63, which means the whole put ratio spread right now will give us a credit of just nice 2 cents. That means if the market was to close above 107.5, right now we are using this strike. If the market closes above 107.5, then we're just going to get just $2. You know, we just get $2. We don't get that much, and we don't get any money, but at least we do not lose money. But here's the thing, because you are more bearish, right? In this case, maybe you have a long stock portfolio already. You have quite a lot of long stock positions. So in this case, you are pretty much trying to hedge your position in case the market goes down, because as the market moves down, most of the stock will go down as well. So when the market goes down past the 100 strike price, you will be making a whopping 7.5 points on this long put spread, right? So 7.5 points is basically $750, right? $7.50. Right, so as you can see, I've just manipulated the strike price. Previously, I've used the 102.5 and the 100 long put spread, and then it gives me a larger credit upfront. Right, but then if the market goes down, I do not make as much. But now that I'm using the 107.5 strike with the 100 for the debit spread, for the long put spread, then I'm going to be making much more as the market goes down. But if the market goes up, then I'm not going to make that much. But if I have a long stock portfolio, the long stock positions will all be making money. All right, so next is if you want to construct with a higher probability of profit, right? If you want to have a higher probability of profit, this is where you can actually construct a put ratio spread with an at the money long strike, right? So let me just remove all this again as well. All right, again, so we're going to be using the short put. The short put is going to be at the 100 strike price, and again for this we're going to receive a credit of $1.65 roughly. Now, so what do I mean by increasing the probability of profit? Now, previously we used these two strike price, right? 102.5, 107.5. Right now the market is somewhere in between 115 and 112.5, right? This is where the current market price is. So for the current market price, right, let's say if you take the 107.5, it would take quite a while before the market actually goes below 107.5. That means for you to make money on your embedded long put spread, the market has to travel quite a bit first before it can start to get into your embedded long put spread, right? And it has to go even further past the 100 for you to make the full profits on your embedded long put spread. But what if you decided to buy the at the money long strike instead for your long put spread, right? So instead of buying the 107.5 or the 102.5, what if I bought the 112.5, right? So if I bought the 112.5, we need to be able to find the short strike, the short leg of this put spread, to be able to have a debit, a total debit that's lesser than $1.65. All right, so let's take a look at which is the short strike that we can use. So again, we're going to take out our calculator. So again, let's see how much we can get. So let's say if we were to buy the 112.5, okay, so that would be minus 5.03, all right, round it off, 5.03, and then we're going to see which is the one that we can get roughly $1.65. So if we were to go to the 107.5 strike price, let's say we're going to buy for 3.28. So in this case, you can see we have to pay $1.75 for this long put spread of 112.5 to 107.5, right? If we were going to buy this two strike for our long put spread, then it's going to be a debit, right? Because we're going to receive $1.65, we're going to pay $1.75. That's going to give us a net debit of $10 or 10 cents, right? We're going to pay $10 to construct this put ratio spread, which is ideally not what we want. So since we cannot sell this 107.5, what we want to do is try the 110, right? So the 110 will most definitely give us a overall debit that is much lesser than $1.65, right? So we're going to take this again. So we're going to take 5.03, and then we are going to add it by 4.08. All right, so this gives us 95 cents in debit, right? So this is just nice, right? We are going to have a debit of minus 0.95, which is going to give us a credit of roughly 70 cents if my maths didn't fail me, right? We're probably going to get 70 cents in credit, and we're going to have this two strike price as our long put spread. So that means for us to make the full profit of this underlying long put spread, the market just has to go down and expire, right, at 110 below, right, below 110. If the market is somewhere in between, anywhere from 100 to 110, we're going to be making the full profits on our long put spread, which is $250, and we won't get a sign on the short put because the market did not close below 100 points. So this way, as you can see, there is a higher probability of profit because it's easier for the market to go below 110 than it is to go below, you know, previously we had the strike price at 107.5 to 100. Right, it's going to be much easier for it to go below 110 than it is to go below 107.5 all the way to 100, right? Previously, we also used another example, which is 102.5, 100, right? It's going to be much easier for the market to drop below 110 than it is to go below, right, 102.5 to 100. So that is how you can actually construct the put ratio spread, right? Your short put, or rather the short leg of your long put spread, does not have to be the same strike as your additional short put, right? You can just change it around anywhere on this put option table down here, right? Next, what if you want to construct for a higher profit potential? So this way, so what you want to do down here is you want to create a put ratio spread with an out the money long strike. So in this case, instead of us buying the long put spread, which is somewhere at the money, you can shift it somewhere down, right? You can push it further out of the money, because when your long put spread is further out of the money, it becomes cheaper, right? Your long put spread is cheaper for the out of the money than it is at the money. All right, so let's get into a trade example so you can take a look at exactly what I mean. By the way, if you found this video helpful so far, please give me a thumbs up and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so I've just recently put on a put ratio spread on Google. So as you can see, these are the strikes that I've chosen. For the long put spread, I've chosen 112.5 and 110. So this will be the maximum profit down here. And then my short put strike is at 102.5, which is just at the previous low down here and also below this support level. So as you can see, this is what I'm talking about. previously, where I want the short put strike, right, the additional short put strike to be at or below the support level. So in this case, it's just nice. I have it at 102.5, and then in this case I decided to go for a higher probability kind of a trade. As mentioned previously, I said that there is a higher probability of profit where I go for the at the money long strike for the embedded long put spread. So in this case I decided to go for the long put spread. There's 112.5 and 110. So this way I have a higher chance for the market for it to make money on this embedded long put spread, because the market just has to go down here at expiration, and I'm going to make the full profits on this embedded long put spread. So for this whole spread down here, I receive a credit of $1.12, which is $112. That means even if the market was to shoot up, it's not like I don't get paid, right? I still get $1.12 for this. So as always, we always want to plan out our different scenarios so you know exactly what to do when the market gets to the different places. All right, so the first scenario is, what if Google goes above 112.5 at expiration, right? So 112.5 is the beginning of our put ratio spread. This is where my long put option is at. So now the market is above down here, so it means that the put ratio spread expires worthless. So straightforward, I just collect the full credit that I receive for selling this put ratio spread, which is $112, right? So once this expires, I'm going to reassess the whole position again. I'm going to take a look, see whether am I going to enter into another put ratio spread or not. Okay, scenario number 2. What if Google is in between 112.5 and 110 expiration? That means it's in between your long put spread. So in this case, on expiration day itself, right, on expiration day itself, before the market closes, I'm going to close this long put spread for a profit, right, regardless of where it is. As long as it's below this long put option, I'm going to close it. And the reason is because if you're going to take this to expiration, your broker is going to exercise this long put option. It means you're going to be short 100 shares. So to avoid this assignment thing, you're going to want to close it just before the market closes. All right, so you can just close it out, take the profit. And then the next thing is that the short put is going to expire worthless. So your total profit is going to be 112 plus the credit you receive from selling the long put spread. Now what about scenario 3? What if Google is in between $110 and $112.50 at expiration? That means it's well past your long put spread, but it's above your short put option. So in this case, your long put spread will be at max profit. In this case, you can close it out for max profit, or you can just leave it to expire worthless, because your broker will net match these two options off, so that you won't be assigned or exercised on this, because they will just cancel it out each other and you're just going to get the profit from it. And then your short put is going to expire worthless, and you're going to receive a total of 112 plus $250, which is $362. All right, so that is for scenario number 3. Now scenario number 4 is, what if the market goes below your short put strike, right, at 102.5. So in this case, you're going to have the max profit again on your long put spread. This time your short put is going to be assigned as we have already planned for. So that means we're going to get long 100 shares at 102.5, and that means we're going to have a total profit of $362 as well. And then now you're going to be long 100 shares at $102.50. So at this point of time, right, once you're long, you can wait for the market to go back up first before you sell a covered call, or you could just hold it out until the market goes further up, then you decide to sell a cover call or get out of your position. All right, so this is the game plan I have on when I put on my put ratio spread. So when you put on your put ratio spread as well, you want to map out all the different scenarios so you know exactly what to do even before the market gets to the different scenarios, right? So many times that there are a lot of traders that they do come and ask, you know, what's going to happen if the market goes, you know, below here? What do I do? What should I do? So all this has to be planned out even before you place the trade. So that means the moment you place this trade, you receive this credit. At this point, it's all going to be mechanical. You're just going to execute the plan according to what happens that you have planned out for the different scenario. All right, guys, so I hope this video has been helpful for you. If it has, please give me a thumbs up, as well as subscribe to my channel for more videos like this. And as always, thank you for watching. Appreciate your time, and may the options favor you.